Currency is a price. An exchange rate is the price of one currency in another. Example: $1 buying more or fewer euros changes travel and trade costs. Currencies move like market prices. Higher returns can pull investors toward a currency. Picture: global investors buy bonds in a country with better yields. Capital flows can strengthen exchange rates. Facts that can be checked: compare inflation, interest rates, trade flows, political risk, and confidence in the country a euro's economy. The weak point appears when global investors buy bonds in a country with better yields. The first practical distinction is inflation weakens purchasing power. High inflation can reduce confidence in a currency. Notice this: if local prices rise quickly, foreign buyers want more currency for the same goods. The practical test is whether the numbers are changing behavior, not just appearing in reports. Think of strong oil exports can support a currency tied to that economy. Goods flows affect money flows. The risk rises when a weaker currency can make imports costlier while a stronger one can hurt exporters and tourism. The practical test is whether the numbers are changing behavior, not just appearing in reports. A daily version is strong oil exports can support a currency tied to that economy. Imports create selling pressure sets up the whole situation. Buying foreign goods often means selling local currency. Think of a country importing more than it exports may face pressure. Trade balances influence direction. The problem grows when a weaker currency can make imports costlier while a stronger one can hurt exporters and tourism. Political risk, debt worries, or banking stress can scare investors before any law actually changes. During an election crisis, traders may sell the currency simply because they fear unstable rules, capital controls, or weaker repayment confidence. Currency markets move on expectations, so a loss of confidence can show up quickly in exchange rates, import costs, and business planning. Central banks intervene sets up the whole situation. Authorities may raise rates, use reserves, or signal support. A central bank sells dollars to defend its own currency. Policy can slow or reverse moves. The danger increases when a weaker currency can make imports costlier while a stronger one can hurt exporters and tourism. Traders bet on future direction and can accelerate momentum. Think of a rumor about rate cuts triggers quick selling. Markets react before facts settle. The useful test is whether the number is changing real behavior. Households feel the change first through bills, jobs, savings, and borrowing decisions. The practical test is whether the numbers are changing behavior, not just appearing in reports. A weaker currency makes foreign travel expensive but can attract visitors. Concrete case: locals pay more abroad while tourists find the country cheaper. Exchange rates change daily life. Put simply, a currency is a price for trust, demand, and expected return in one country a euro's money. Think of a retailer importing electronics must pay more for the same stock. Currency risk can become inflation. The cost grows when a weaker currency can make imports costlier while a stronger one can hurt exporters and tourism. The weak point appears when a retailer importing electronics must pay more for the same stock. Borrowing in foreign currency is risky if local money weakens. Version: a company earning locally owes dollars and sees payments jump. Currency mismatch can be dangerous. Late action often costs more than an early correction. At the end, a currency is a price for trust, demand, and expected return in one country a euro's money. The main lever is pegs and free floats differ. Some currencies are managed while others move freely. Common case: a pegged currency may stay stable until reserves or policy credibility weaken. The practical test is whether the numbers are changing behavior, not just appearing in reports. In plain terms, a currency is a price for trust, demand, and expected return in one country a euro's money. What makes the topic useful is the connection between bond yields and the decision that follows. Safe havens rise in fear can decide whether the situation stays manageable or becomes expensive. Think of money moves to perceived safety during crises. A familiar case is money moves to perceived safety during crises. A practical check is import prices, then central bank rates. Together they show whether the response matches the real cause. The everyday problem is commodity currencies react. Countries tied to oil, metals, or agriculture may move with those prices. Daily version. Falling copper prices can pressure an exporter euro-s currency. Exports connect currencies to commodities. The same facts become easier to read when the cause is clear. The real-world test is tourist budgets. If that changes, the outcome usually changes too. This starts with real exchange rate. A currency can look strong nominally but lose competitiveness after inflation. Concrete case. Wages and prices rising faster than partners make exports expensive. Competitiveness is more than the headline rate. The simplest check is travel costs, invoices, remittances, and import prices, because it replaces guessing with something observable. Households should hedge big needs. Daily version. Saving for foreign study exposes a family to exchange risk. Match savings to future currency needs. Pressure builds when a weaker currency can make imports costlier while a stronger one can hurt exporters and tourism. Currencies respond to trust as much as arithmetic. A country with higher yields but weak confidence may not attract money for long. No one controls every move. Exchange rates combine policy, trade, psychology, and global capital. Example. Even experts miss turning points. Avoid treating currency forecasts as certainty. In practice, even experts miss turning points. A traveler notices the currency move at the exchange counter, but the move may have started with bond yields, trade data, or political risk. Currencies rise and fall because people constantly compare trust, returns, trade, inflation, and risk between countries. A strong currency can help buyers and travelers, while a weak one can help exporters and hurt importers. The exchange rate is a daily vote on confidence, not just a number on a screen. Exporters may benefit from a cheaper currency because foreign buyers can purchase their goods at a more attractive price. Importers, tourists, exporters, and investors all feel the exchange rate differently, even though they are looking at the same currency. A currency moves when people want more or less exposure to the country behind it. Higher interest rates may attract investors, while inflation, political uncertainty, debt worries, or weak exports can push demand away. A currency rises or falls because people, companies, and investors are constantly deciding where money is safer, more useful, or more rewarding. A familiar case is an importer pays more after the local currency weakens. A currency is a vote of confidence that is counted every day in markets. Currency weakness can make exports cheaper while making imported food, fuel, phones, and machinery more expensive. A falling currency can help exporters while hurting families who rely on imported food, fuel, medicine, phones, or tuition abroad. The exchange rate is the visible number. Under it sit trade flows, interest rates, inflation expectations, debt concerns, and confidence in the country behind the currency. Trade, inflation, interest rates, political trust, debt, and investor demand all decide whether people want to hold that money or exchange it for something else. For importers, tourists, and families receiving money from abroad, the exchange rate turns global confidence into a daily cost.